Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Smurfit Westrock, ticker SW.
Yeah, and this one's fascinating. We're really looking at what we're calling the merger paradox here.
Merger paradox. Explain that.
Well, you got this newly formed giant, right? A roughly $20 billion global player. And internally, they seem to be executing a textbook turnaround, hitting synergy goals, generating fantastic cash flow.
Okay, sounds good so far.
But then Q3 2025 results land, and bam, the stock drops nearly 9%.
Ouch.
Exactly. So our mission today, for you listening, is to really define this core conflict. Why did the market punish what looks like operational success? And does that create a potential opening, a buying opportunity, if you look past the immediate noise?
Right, that's the key question. We need to unpack this tension. You've got the macro risks on one side and the strong internal execution story on the other. Smurfit Westrock SW, it wasn't formed that long ago, back in July 2024. It was that massive combination of Smurfit Kappa and Westrock.
And this wasn't just, sticking two companies together. This created a genuine world leader in sustainable fiber-based packaging. A true global behemoth.
The scale is just immense. You really need to get your head around it.
Absolutely. We're talking operations in 40 countries, about 100,000 employees, and like I said, around a $20 billion valuation when it launched.
They do everything from, the huge containerboard rolls down to specialized consumer packaging. They're kind of the backbone for a lot of global supply chains.
And it's important to remember, this merger didn't just happen quietly.
No, not at all.
It really acted as a catalyst, didn't it? It set off this wave of consolidation across the whole packaging industry.
Yeah, you immediately saw International Paper go after DS Smith. There was all that activity with Suzano, too. SW didn't just join the party, they arguably started it, reshaping the whole global paper market landscape.
So, okay, massive new company reshaping the industry. Let's dive straight into those Q3 2025 financials, because that's really where the paradox of the conflict begins.
Right, because if you just glanced at the top line, maybe the middle line, you'd think, wow, they crushed it, especially considering they're still integrating these two huge organizations.
Exactly. Look at the top line strength. Net sales.
Yeah.
$8.003 billion.
Solid number.
Very solid. And up 4.3% year over year.
Okay.
It beat the consensus estimates quite clearly. North America brought in $4.72 billion. And even the combined EMEA and APAC regions, they showed decent growth, up 6.8%.
Okay, so sales looking good. What about operational profit?
That's the other piece. Adjusted EBITDA came in at $1.302 billion. And crucially, that was right in line with management's own guidance.
So they hit their target.
They hit their target. They gave them a solid adjusted EBITDA margin for the group, 16.3%. It really confirms that operationally things are moving in the right direction. The merger synergies seem to be flowing through.
But for me, the really telling number, the one that speaks volumes about financial health, is the cash flow.
Oh, absolutely. Adjusted free cash flow. That's the cash left after, essential spending on equipment and managing inventory and payments.
Right. The real cash.
It came in at an exceptional $579 million for the quarter.
Wow.
And get this, the CFO, Ken Bowles, he specifically pointed out that they're, and I quote, only starting to get going on working capital optimization.
So there's potentially more to come on that front.
That's the implication. Think about it, generating over $500 million in free cash in just 3 months while juggling one of the biggest integrations this industry has ever seen.
That's pretty impressive financial discipline.
It really is. And they didn't forget shareholders either. They declared the quarterly dividend, 0.4308 cents per share, keeping with their progressive dividend policy.
Okay, so let's recap. Strong sales growth, beating estimates, operational profit, the EBITDA, right on target, massive free cash flow generation, and a steady dividend.
Sounds pretty good, doesn't it?
It does. So why on earth did the stock crater almost 9%?
Here's the rub. It came down to the bottom line, adjusted basic earnings per share, EPS.
The number everyone watches.
Exactly. The street, the analysts, they were looking for something around 68 cents. Maybe, the more optimistic ones were up at 72 cents.
And what did SW deliver?
Just Baldur's 58 cents.
Oh, a 10-cent miss.
A 10-cent miss. And that miss, combined with the revised guidance that came with it, which stemmed from the demand picture that triggered a really emotional reaction in the market.
Emotional is definitely the word. After that earnings announcement on October 29th, 2025, the stock just plunged. Lost $5.15, hit $37.94, almost a 9% drop.
Yeah, it felt like the market just completely ignored the operational wins, the cash flow, the integration progress.
And focused solely on that EPS miss and the uncertainty going forward.
Precisely.
Yeah.
And that sets up our whole deep dive today. We need to define that external market risk, the thing that drove the guidance cut, versus the, frankly, undeniable momentum of their internal turnaround.
Okay, let's dig into that central conflict then, because as you said, the drop wasn't really about management failing to execute on things within their control. They hit the EBITDA target they set.
Right.
The stock fell because of, well, two big things: ongoing weakness in the macro environment and the cut to Q4 guidance that resulted from it.
That's exactly where the market's attention snapped. And you have to say, the communication from the top, particularly from CEO Tony Smurfit, was remarkably blunt.
Yeah, I noticed that, especially about the containerboard market.
He didn't mince words, did he?
Yeah.
His assessment, particularly for Europe, was pretty stark. He flat out said the market is, quote, pretty bad right now.
That's not the usual corporate speak like challenging or soft. Pretty bad is direct.
It's direct. And it felt less like managing expectations and more like a genuine warning for the entire sector.
He also predicted more pain to come, didn't he?
He did. He said he sees more mill closures coming across the industry. He emphasized that for many operators, the pain is very, very real.
Which implies the industry basically has too much capacity right now.
That's the clear implication. The demand just isn't there to support the current supply structure. So rationalization, shutting down older, less efficient mills, it becomes necessary.
And the core issue is that hoped-for demand recovery. It just hasn't shown up.
No. Everyone was kind of hoping for that usual seasonal pickup, especially going into October, the Q4 ramp-up.
But it fizzled.
It fizzled. The CFO, Ken Bowles, he noted that demand patterns in the U.S. still don't seem to be there. And he pointed specifically to weakness in major consumer areas.
Yeah, things like confectionery, packaged foods, general retail, even e-commerce, which you'd think could be more resilient.
When those core segments are soft, it hits the demand for corrugated boxes almost immediately. And the numbers showed it. North American corrugated volumes were down significantly in Q3, 8.7% lower on a same-day basis.
Okay, but hold on. Didn't management say some of that drop was intentional?
They did, and this is a really important point for judging their strategy. Management maintains that about 5% of that 8.7% volume decline was a conscious choice.
Editorial.
Yeah, a planned exit from what they call uneconomic business, basically low margin or even loss-making contracts they decide to walk away from.
So roughly 3.7% was actual market softness and 5% was strategic pruning.
That's their position. Now, the market might debate that exact split, sure, but the underlying strategy, choosing profitability over just filling machines, that's absolutely central to their turnaround story, which we need to get into.
Okay. So weak demand, no real pickup, and this strategic shedding of bad volume. What did they do about it for Q4?
Well, faced with that unpredictable demand and the need to rationalize, they made a tactical call. Take additional economic production downtime in the fourth quarter.
Meaning deliberately running the machines less.
Exactly. Primarily in the North American system.
Yeah.
It's a management decision to prioritize margins, manage inventory levels carefully, rather than just chasing volume to keep utilization rates high.
That sounds prudent strategically, but it must have a cost.
And that's what spooked the market. This planned Q4 downtime, it comes with a specific price tag. They estimate it will cause an additional hit to Q4 earnings of between $60 million and $70 million.
Okay, there's the direct link.
That's the direct link. And that $60–70 million hit, in turn, forced them to revise their full-year adjusted EBITDA guidance downwards.
What was the change?
The original range was $5 billion to $5.2 billion. They adjusted that down to a new range of $4.9 billion to $5.1 billion.
So shaving $100 million off the top end of the guidance.
Right. Driven mostly by that short-term $60–70 million operational decision in Q4. And that's what the market reacted to, that uncertainty, that downward revision, even if the strategic reason behind it makes sense long-term.
Okay, so that's the macro headwind side, the market risk. But you said this is a perfect pivot point.
It really is. Because while those macro headlines were driving fear, the story inside the company, the execution story, that justifies confidence. Let's look at that turnaround. It's not just working, it seems to be accelerating.
First off, the merger synergies. Are they delivering on those promises?
Absolutely. They are still firmly on track to deliver that initial target, $400 million in cost synergies at a full run rate by the end of 2025.
So the basic math of the merger is holding up.
It's validated.
Yeah.
But here's where it gets really interesting for the upside. They've gone beyond that initial $400 million.
Oh.
Management has already identified, they say, a minimum of another $400 million in additional operational and commercial improvements they think they can capture.
Wow, so potentially $800 million in total improvements. Where's that coming from?
It's pure upside potential, really, driven by taking the best practices from the Smurfit Kappa side, which was always known for operational excellence, and applying them across the legacy Westrock platform, particularly in North America.
And a big part of that, especially in North America, is this shift in operating philosophy, right? The owner-operator model.
Yes. This is huge. It's more than just shuffling boxes on an org chart. It feels like a genuine cultural revolution for the legacy Westrock business.
How so? What's the difference?
Well, the old Westrock model had become, by many accounts, quite centralized. In that kind of system, your local plant managers can sometimes end up being
Well, administrative.
just running the assets they're told to run, pretty much. They might not have had full visibility or, crucially, full accountability for the profitability of their specific plant or customer contracts. Corporate might have absorbed losses centrally.
Okay, so what does the owner-operator model change?
It flips that completely. It requires every single box plant, every paper mill, to run almost as a standalone company, as they put it.
Yeah.
Meaning local managers get full P&L responsibility. They're not just managing machines anymore, they're running a business unit. And their clear instruction is to prioritize value over volume.
Okay, so that connects back to shedding that unprofitable business we talked about earlier.
Exactly. Under the old system, maybe you keep a customer even if they have, say, negative 30% or 40% margins, as management cited, because, it keeps the machines running, helps absorb overhead maybe.
But now?
Now, that local manager is not only empowered but expected to do something about it. That means renegotiate for better terms, find ways to serve them more profitably, or, if necessary, exit that business entirely.
That's a sharp focus.
It's a very sharp, decentralized focus. And it directly tackles that legacy issue, where high volume sometimes masked deeply unprofitable operations.
And this aggressive push for profitability, it must be driving the asset rationalization program we've seen, the closures.
Directly, to really right-size the business for profitability, not just scale. They've been pretty ruthless, frankly, in shutting down inefficient or loss-making sites.
The pace has been quite something.
It really has. Since the merger closed, they've already actioned closures for 3 paper mills, 1 paper machine, and 18 converting facilities.
Okay.
These aren't just lines on a spreadsheet. This is physical capacity being taken out.
Yeah, we saw the headlines. That plant in Cedar Rapids, Iowa, 100 employees affected. A corrugated facility in California, 141 jobs. These are real impact.
They are. And the total effect, capacity-wise, is the removal of about 500,000 tons of production capacity from the market.
500,000 tons.
500,000 tons. And that comes alongside a permanent global headcount reduction across the board of over 4,500 people. It just shows the level of commitment to efficiency.
Taking out that much capacity strategically, what does that achieve beyond just stopping the losses at those specific sites?
Well, 2 critical things, I think. First, yes, it eliminates the direct financial bleed from those high-cost, inefficient assets. That's immediate P&L relief.
Okay, 10 seconds.
Second, and maybe just as important long-term, it imposes some much-needed supply discipline on the wider North American containerboard market, which, as the CEO said, is pretty bad, partly due to oversupply.
Right. Taking supply out helps put a floor under pricing for everyone else.
Exactly. Especially for SW's remaining higher-quality mills. It helps stabilize the market they operate in.
So what's the bottom line result of all this? Is the North American turnaround actually showing up in the numbers?
Yes. And this, for me, is probably the single most convincing metric that the strategy is working. Remember that unprofitable business they chose to exit?
Yeah, the 5% of the volume drop.
By consciously shedding those old low-margin contracts, they have cut the number of loss-making corrugated units, specifically in North America, by almost 50% in just 1 year.
50% reduction in loss-making units. That's significant.
It's huge. And the result? As of the end of Q3 2025, management stated that over 70% of their North American corrugated operations are now classified as solidly profitable.
70%.
70%.
Yeah.
It really demonstrates that this decentralized, performance-driven owner-operator culture, it's delivering exactly what they intended. It's providing a buffer, some insulation against that tough macro demand picture.
Okay, that is a massive shift internally. So where does all this cash flow, this renewed focus, go next? What are the future catalysts?
Well, they're not just cutting costs and sitting back. Management is signaling they're doubling down on investment, particularly to upgrade those legacy North American assets they acquired.
How much are we talking?
Despite taking that Q4 downtime, they've committed to a pretty aggressive capital expenditure plan for 2026. They're targeting $2.4 billion to $2.5 billion in CapEx.
$2.5 billion. That's a serious vote of confidence in the future.
It really is. It signals they're not just in survival mode, they're actively investing for efficiency, for quality, and for high-return projects.
And where is that money going specifically?
What's interesting is the distribution. Management explicitly said the spending will be slightly skewed more toward legacy Westrock assets.
Why the skew towards the old Westrock side?
The rationale given was that the European and Latin American assets, which came mostly from the Smurfit Kappa side, were generally already very well invested. They had a history of continuous reinvestment.
Whereas the U.S. assets, maybe not so much.
The implication was that, historically, Westrock's investment might have been skewed a bit more towards, say, capital structure optimization or M&A, rather than consistent state-of-the-art upgrades within the mills and plants themselves.
Got it. So this $2.5 billion is partly about bringing the U.S. footprint up to the global SW standard.
Exactly. They're targeting big improvements in product quality, in customer service levels, and specifically upgrading the corrugating machines across North America.
Any specific examples?
Yeah, they highlighted one high-return project they just approved, converting the big mill in Covington, Virginia, from running on coal to natural gas.
Ah, an energy project.
Right. That hits multiple goals. It improves their sustainability profile, which is increasingly important, but it also directly drives down energy costs, boosting the mill's profitability.
Makes sense. Okay, so they're investing heavily. But the big question the market always asks is, when will the volume come back? Especially in North America.
Yeah, the demand question. CEO Tony Smurfit addressed this directly. He gave a pretty specific timeline forecast.
What did he say?
He said he expects North American volume performance to start, quote, inflecting more positively versus the industry by the third quarter of next year. So Q3 2026.
Q3 2026. Why that specific timing?
It seems critical because it accounts for the lag effect from all that business rationalization they've been doing.
Ah, the unprofitable contracts they're shedding.
Exactly. Management noted they still have some very poor pieces of business, as they termed it, still under contract, and those will finally run out during the first half of 2026, Q1 and Q2.
So once those are fully washed out of the system?
Right. Once those are gone and the new higher quality business they've presumably been winning based on better service and quality starts flowing through without being dragged down by those legacy dogs, that's when they expect to see that clear, positive inflection point versus the overall market trend.
Okay, that's a clear timeline at least. While North America works through that stabilization, how are other regions performing?
Well, this highlights the benefit of their global diversification. They have a really reliable, high-margin growth engine that's already firing on all cylinders. Latin America.
Right, LATAM. How's that looking?
Management calls it a compelling growth region, and the numbers back it up. Profitability is excellent. They delivered an adjusted EBITDA margin of 21.3% in Q3.
21.2%. That's significantly higher than the overall group average of 16.3%.
Way higher. It really shows how effectively they've applied that value over volume strategy in markets that actually are growing.
And is the volume growth there?
Oh yeah. Really strong performance in key countries in Q3. Colombia was up 8%, Chile saw 15% volume growth, and Peru was just booming, up 25%.
Wow. So that LATAM strength provides a nice cushion while Europe and North America navigate these containerboard headwinds.
Absolutely. It underscores the strategic value of having that diverse global footprint.
Okay, this is where, for me, the story shifts from defense cost-cutting rationalization to offense, the long-term potential.
Exactly. The financial thesis, the turnaround, that gets you comfortable with the execution. But the real excitement, the growth story, it really hinges on innovations, sustainability, and especially that big theme of replacing plastic.
Right. And they seem to be making some concrete moves there, particularly in consumer paperboard.
A really profound move, actually, and it's quantified. They are actively strategically shifting customers away from coated recycled board CRB.
CRB, that's the standard, often grayish board made from recycled fibers.
Exactly. Think standard cereal boxes, maybe. They're moving customers towards higher performing grades. Solid bleached sulfate, SBS, and coated unbleached kraft, CUK.
Okay, break those down for us. SBS is the bright white stuff.
Right. SBS is premium, usually made from virgin fiber. Think high-end cosmetics packaging, pharmaceutical boxes, super bright, great printing surface. CUK, coated unbleached craft that's known more for its strength. Often brown on the inside, like beer cartons or frozen food packaging, where toughness matters.
So why the big shift away from the standard recycled CRB? Isn't recycled usually cheaper?
Well, that's the key economic driver right now. The price gap has narrowed significantly. Management is saying the price of SBS has actually become competitive with CRB lately.
Ah, okay, so the cost barrier is lower.
Much lower. And SBS offers real performance advantages. Obviously, the superior brightness for shelf appeal. But critically, SBS allows you to run a lower caliper.
Lower caliper meaning thinner board.
Thinner board, yes, while achieving the same strength and stiffness as a thicker CRB sheet.
Okay, why is thinner better?
Think about it from the customer's perspective. Less material per box means the box weighs less.
Lower weight
Not
means lower shipping costs.
bingo. Massive freight cost savings, which is a huge deal for consumer goods companies. Plus, they mentioned SBS runs better, smoother, on modern high-speed printing and packing lines, which means less downtime for their customers.
So it's a win-win. Better performance, potentially lower total cost for the customer. Is this shift actually happening?
It is. And they put a number on it. They said approximately $100 million worth of business has already transitioned from CRB to these higher value SBS and CUK grades just in the last 4 to 5 months.
$100 million already shifted.
Yeah,
That's real validation of the strategy.
it really is. It shows customers seeing the value proposition.
And this move towards higher performance, often virgin fiber-based boards like SBS, it ties into the bigger theme of replacing plastics, doesn't it?
Absolutely. This material substitution is kind of foundational for tackling those plastic displacement opportunities, which is where so much regulatory pressure and consumer demand is focused globally.
Do they have specific examples of replacing plastic?
Several really good ones they highlighted. For industrial uses, they launched something called the bag-in-box power grip.
Okay, what's that?
Think of those big, rigid plastic HDPE bottles or jerry cans that hold things like motor oil, cleaning chemicals, maybe food ingredients. This power grip is a direct replacement. It uses a strong cardboard outer casing with a flexible bag inside.
Like wine boxes, but heavy duty.
Kinda, yeah. But the key stat is it contains up to 75% less plastic than the rigid HDPE container it replaces. That's a huge sustainability improvement and a powerful selling point.
75% less plastic. Okay, what else?
They're also pushing into more technical areas, protecting fragile goods during shipping. They developed a corrugated cardboard solution using their hexacomb material.
Hexacomb, like a paper honeycomb.
Exactly. Very rigid, very strong, but paper-based. They're using it for things like medical devices. They mentioned a brand called Dermalux, replacing traditional expanded polystyrene, EPS, or other plastic foam packaging.
So replacing styrofoam, essentially.
Replacing styrofoam, plastic trays, things like that. They're even tackling small stuff, like bubble wrap.
Paper bubble wrap.
Sort of. They developed a shaped, sculptured E-flute corrugated solution that acts as void fill and protection for small items like electrical connectors, replacing single-use plastic bubble wrap.
And presumably, all this paper-based stuff is easier to recycle.
Way easier. It's typically delivered flat-packed, easy for the end user to assemble, fully recyclable in standard paper streams, and often FSC certified for sustainable sourcing. It hits all the right notes for companies trying to ditch plastic.
Beyond the materials themselves, are they investing in the manufacturing side to support this?
Yeah, they highlighted a focus on automation. Specifically, they showed off cobot loading machines at a recent trade show, Drink Tech.
Cobots, collaborative robots.
Right. These aren't meant to replace people entirely, but to handle the repetitive manual loading and handling tasks. This becomes more important as you deal with more product variations, more SKUs, which is definitely the trend.
And the idea is the cobots help the human workers.
That was management's clear message. The cobots aid the workers. They take away the physically strenuous or repetitive bits, freeing up the human operators to manage multiple lines, focus on quality control, handle changeovers, the higher value tasks that require human intelligence and skill.
So augmentation, not replacement.
That's the philosophy they're putting forward.
Okay, one last piece on innovation. They mentioned something about experiential packaging.
Yeah, just a fun anecdote, really, but it shows they're thinking beyond just containment. They highlighted a promotion with Papa John's in Latin America, the Tremendo Triplet Box.
What was that?
It was this cool 3-tiered pizza box that, after you ate the pizza, could be converted into a mini football goal or a basketball hoop for kids.
Huh, that's clever.
Right. It just highlights how packaging itself can become part of the consumer experience, part of the promotion, adding value beyond just protecting the product.
Okay, so let's bring this all together. We've gone through the financials, the market headwinds, the internal turnaround, the future investments, the innovation. How do we reconcile this merger paradox?
Well, bringing it all back, I think the investment conclusion becomes pretty clear. That 9% stock drop, it feels like a temporary cyclical headwind reaction.
Driven by the containerboard softness and that Q4 downtime costs.
Exactly. The market seems to be laser-focused, maybe myopically focused, on that short-term guidance revision.
But as we've discussed, that focus seems to be obscuring the much bigger, arguably more powerful story of rapid and robust internal execution.
Completely. Management is delivering point by point on the things they can control. That $400 million synergy target, on track. The massive shift to the owner-operator model in North America, working. The reduction in loss-making business, getting over 70% of NA ops solidly profitable. Done.
The market might be sweating the $60 million Q4 impact,
While potentially ignoring the multi-year tailwind from $800 million or more in combined cost savings and operational improvements.
So from a valuation perspective, where does that leave the stock? It dropped to around $37.94.
Right. But even after that drop, the analysts who follow the company closely, they're largely maintaining a consensus buy rating. And the average target price out there is around $57.90.
$57.90 versus a stock price under $38. That suggests pretty significant undervaluation.
It does. They're calculating it's trading at roughly a 20% discount compared to its peers in the sector.
And while you potentially wait for the market's sentiment to catch up or for that macro environment to improve,
You've got that progressive dividend, that 0.4308 per share per quarter. It provides a tangible return, a bit of a safety net, while navigating this temporary slump.
okay, so that brings us to the final thought, the provocative question for the listener.
Right. We saw concrete proof that they successfully pivoted $100 million worth of business away from basic CRB towards those higher margin, better performing SBS and CUK grades, just based on recent price competitiveness.
And management hinted they're looking at more.
They did. They mentioned they're working through different strategies related to potentially converting more milk capacity, specifically towards SBS, and they promised a fuller update in February 2026.
So the provocative question is,
Given how quickly and successfully they shifted that first $100 million tranche, what could the long-term margin expansion, the real value creation, look like if Smurfit Westrock decides to commit significant CapEx, maybe a chunk of that $2.5 billion plan for 2026, to converting even more paperboard capacity to these high-margin, differentiated SBS and CUK products?
leaning into that plastic substitution megatrend even harder.
Exactly. Capitalizing fully on that global demand, driven by regulation and consumers, to replace plastic packaging. That potential feels much larger, much more structural than the temporary cyclical weakness in the containerboard market that seems to be dominating the stock price right now.
Risk defined.
Portfolio protected.